let's talk about how a simple idea, maybe one sketched on a napkin, can just explode into a company worth billions of dollars. Today, we're going to crack open the engine that makes that happen: venture capital. And to really get a feel for its power, let's just start with one absolutely staggering number: $16 billion. Just take a second and let that sink in. I mean, what does a number that big even represent in the real world? Well, it's the price tag. It's what Walmart paid back in 2018 to buy Flipkart, an Indian company that literally started out as an online bookstore. This was a massive, massive bet on the future of India's market, and wow, what a jaw-dropping payout for the people who invested in Flipkart early on. But that's the real question, isn't it? How on earth does a small online bookstore scale up to be worth $16 billion in just a little over a decade? The answer is an engine that is specifically designed for that kind of explosive growth: venture capital. So, how does this engine actually work? Here's our game plan. We're going to start with who's writing the checks. Then we'll get inside their heads to understand their all-or-nothing mindset. We'll decode the deals they make, see how it fueled some of India's biggest tech companies, and finally, we'll get to the fun part: the art of cashing out. All right, so before any company can really take off, it needs fuel. It needs money. That very first check is a huge leap of faith, and it usually comes from one of two very different types of people. Okay, the absolute key difference here is whose money is on the line. Angel investors, they're using their own personal cash. VCs, or venture capitalists, on the other hand, are professionals. They're investing other people's money that's been pooled into a fund. And that one distinction, well, it changes absolutely everything, from how big the checks are to how much control they want. And because VCs are managing a whole fund, not just their own bank account, they operate with a very particular philosophy. You know, they're not trying to build a portfolio of safe, steady companies. No, they're hunting for that one investment that's going to change everything. This quote right here, it basically captures the entire soul of the industry. It's a game of outliers. VCs aren't trying to hit a bunch of singles and doubles. They're swinging for the fences every single time, looking for that one grand slam home run that pays for all the strikeouts. And this leads to a very specific mathematical reality. It's called the power law. See, unlike a normal bell curve where most things are average, venture capital is totally skewed to the extreme. A tiny, tiny number of huge winners generate almost all of the profit for the entire fund, while most investments, well, they fizzle out. And this law totally dominates in tech because of scalability, right? A winning software company can serve millions of new customers for almost zero extra cost. And the data completely backs this up. Look at this. A staggering 65% of all venture deals fail to even return the money that was put in. They lose money, and only a tiny 4% deliver those massive 10x or more returns that make the whole fund a home run. That is the high-stakes game VCs are playing. So, with the stakes being that high, how is a deal actually put together? How does that all-or-nothing mindset get translated into a legal agreement? Well, it all kicks off with one really important document that basically sets the rules of the game. Meet the term sheet. Now, this isn't the final legally binding contract, but it's the blueprint for it. Think of it like a marriage proposal. It lays out all the big stuff, the money, the power, before the lawyers dive in and spend weeks drafting hundreds of pages of documents. Now, getting a term sheet is a huge milestone for a startup, for sure, but it's not the end of the road. In fact, it kicks off the most intense phase of all: due diligence. This is when the investors go through everything with a fine-tooth comb to verify every single claim before any money actually gets wired. When you boil it all down, every single term sheet negotiation is really a battle on two main fronts. First, you've got the economics. What's the company's worth, and how big of a slice does the founder have to give away? And second, you've got control. Who gets a seat on the board, and who gets the power to say no to big decisions? It's always this delicate dance between money and power. Okay, so let's take all this theory and see how it actually played out in the real world, because this process is what fueled the insane rise of some of India's most famous tech companies. Let's go right back to Flipkart. So they were founded in 2007, but it was 2009 when they landed that first all-important VC check. That cash infusion was basically rocket fuel. It let them expand way beyond books, build out a huge logistics network, and buy up other key companies to really cement their spot at the top. And look, this wasn't some isolated incident. It's the same story for Ola, which used venture capital to go head-to-head with Uber and branch out into new areas. Same for Paytm. It used huge VC rounds to become the face of digital payments in India, and it was perfectly timed to just explode after big government policy changes. You see the pattern, right? Venture capital enables hyperscale growth. But here's the thing you have to remember about VCs. They're not in it to hold on to a company forever. Their entire business model depends on an endgame, a moment when they can turn that on-paper investment into cold, hard cash. This is what's known as the exit. An exit is the moment of truth. It's the finish line of what's usually a 7 to 10-year marathon. It's where everyone who took a risk, investors and founders, finally gets a return. They sell their private company shares, which you can't just trade on the stock market, and turn them into something liquid, like cash. And there are really two main paths to get there. There's the IPO, or initial public offering, which can create incredible wealth. But man, it is a grueling, expensive, and risky process. Then there's an acquisition, where a bigger company just buys the startup. This is usually a much faster and more certain way to get paid, even if the final check isn't as huge as a blockbuster IPO. And that brings us right back to where we started. That $16 billion Walmart deal wasn't just a sale, it was the ultimate exit. It was the power law winner that delivered mind-blowing returns to Accel Partners and all the other VCs who backed Flipkart for over a decade. It was the proof that their high-risk bet paid off. So there's no question that venture capital is this incredibly powerful engine for innovation. It creates global giants out of garage startups, but it also comes with this intense pressure. The hunt for those few massive winners drives a grow-at-all-costs mentality. And that kind of leaves us with one final thing to think about. What is the true cost of that kind of growth?